Hey everyone, me Kevin here. The S&P just broke pre-pandemic all-time highs. Take a look at this. I mean, this means we now have an overall more expensive stock market than we had before the pandemic, and Tesla is not even included in the S&P 500 yet. See, back on February 19th, 2020, while we were blissfully cheering along the greatest stock market rally ever and mostly ignoring the threat of some virus in China and Italy, the S&P 500 hit 3,386.15. Today, it closed at about 3.5 points above that at 3,389.78. Real estate prices have skyrocketed, houses are hitting the market for higher prices than ever before, and they're getting multiple offers over the asking price. But hey, this all happened in the last 6 months, so maybe there's some really good news. Well, if we turn back the page, we'll see that almost 5.5 million Americans have contracted the coronavirus. 170,000 of them have died, and the United States spent trillions of dollars trying to bail out America while major retailers like J.Crew, JCPenney, Neiman Marcus go bankrupt. Amazon takes over grocery shopping and online retail and then moves into the same bankrupted stores that they basically bankrupted. And now we meme the Federal Reserve chairman as a dude who literally just does this all day with his money printer going brrrr. This now leaves a lot of us asking, what's going to crash the market? Because there has to be one. Is it going to be the election? Perhaps Donald Trump disputing a rigged election? Or will the Biden-Harris tax plan spook investors with a higher corporate tax rate and a financial transactions tax? Or better yet, is massive inflation going to come to make all of our money worthless in some form of great reset? Well, in this video, I'm going to analyze 3 big risks. We're going to look at the inflation and hyperinflation risk and talk about something nobody has talked about before on this platform. We'll talk about the election and some potential outcomes through various scenarios, and then we'll talk about the pandemic. Let's get started right after mentioning my sponsors. Number 1, life insurance you can get in as little as 5 minutes. You'll need it in times like these. This is sparkling water. Number 2, you can get 2 free stocks with Webull when you deposit $100. And of course, number 3, my favorite sponsor of all, my amazing courses linked down below, like the popular YouTube course or real estate investing course. Use that coupon code and join. All right, first, problem. Number 1, inflation. Many of you have heard that the price of gold has been skyrocketing, and Warren Buffett just disclosed on Friday that Berkshire Hathaway now holds over $565 million in Barrick gold. This is the world's second largest gold miner, and he is now the 11th largest shareholder with Berkshire Hathaway in this company, which is really shocking for 2 reasons. One, it's a huge amount of money, and it's very sudden. But the second big reason is it comes after Warren Buffett for decades, can't even say it clearly, decades, has pledged that gold is not something he invests in. In fact, he says he doesn't like gold because he calls gold, quote, non-productive. He says you can hold gold and you could coddle gold, but you can't make money with gold like you can with real estate or companies. It's not like a farm where you can produce money with a farm. You can't produce money with gold. Now, in fairness to Warren, his investment was an investment into a mining company. And it's a company that pays about a 0.5% dividend. The stock is up about 10% since Warren Buffett announced his holdings, so it's not really gold itself. But it does come at the same time as Warren Buffett has unloaded billions of dollars in banks like Wells Fargo and JPM, which many see this as a possible dangerous sign that maybe economic conditions are so uneasy that people are now using gold as a safety net thanks to super low interest rates, high inflation potential due to high stimulus, and the concern over a future loss in the value of money. And maybe Warren Buffett sees that concern is so real and says, you know what? Let's be the dude selling the gold shovel during the gold rush. That is, let's buy the gold miner. This has all led to the recent rise in not only the price of gold per ounce, but also the cost of Bitcoin and smaller cryptocurrencies seeing massive speculative run-ups. But is this true? Are we going to see massive inflation that is going to crush our market? Are we going to see hyperinflation that is going to destroy the value of our currency? To answer this, we have to break down 2 things. Number 1, demand, and number 2, politics. The easiest way to look at demand is by looking at a country like China. China went through this pandemic first and came out of this pandemic first. And guess what happened in China? Well, Chinese consumption has fallen for the 7th straight month, which is very odd. In fact, people in China are saying that supply side production has been rebounding faster than the demand side, and that instead people are saving money and spending less money as people are concerned about the possibility of future outbreaks and potentially less stimulus in the long run. In other words, people are becoming more frugal. More frugality leads to less spending. And when you have less spending, you have less price pressure. See, ordinarily, you get inflation because everybody wants to buy something. If everybody wants to buy this bottle of sparkling water, then the price of it is going to go up until I could get my highest price for it. That's a free market. The problem is if you have less people demanding products, the pressure on prices going up actually stays low. So if China is any example as to what potentially could happen in the United States, and if we truly do go into a frugal decade after this pandemic blows over, which hopefully it will, knock on wood, then we might not actually see the inflation that we're expecting, unless people go right back to spending like we used to, which there are some signs of spending increasing, but that has recently only been because of the massive amount of stimulus that we've seen. We've already had CEOs of companies like Walmart say, don't expect these numbers to last. The stimulus has worn off, and as soon as the stimulus started wearing off, what did we see at Walmart? Sales starting to decline again. The second thing that impacts inflation that nobody likes to talk about on this platform, it's when we think about inflation, we usually think about money printing. Well, all this money is being printed, that's gotta stimulate demand, right? Not necessarily, because money being printed at the federal level doesn't necessarily make it over to the people. Instead, what tends to have a bigger impact on inflation is actually politics. Yeah, politics. That seems really weird, because how can we disconnect the money printer from where the money is actually going? I don't know, but it's practically what's been happening. In fact, the Federal Reserve itself has a goal to have an inflation target of around 2%, and they want to try to shoot past that. Unfortunately, the only thing that's shooting up right now is food prices. And that's not because of more demand or money printing, it's because of supply chain issues. But otherwise, what's actually happening? Well, household savings are going straight through the roof. This actually lowers the velocity of money, which lowers inflation pressure. The Phillips curve, which used to describe the relationship between employment and inflation, has failed to predict inflation because we have really high unemployment, but next to no inflation. So fears of stagflation aren't really coming true right now, at least. But these are all signals, right? I mean, these should all be signals that inflation is coming. It's just a matter of time. But wait a minute. If we actually focus on politics, we could use politics to describe when inflation has actually happened historically. When we look at recent examples of countries that have had hyperinflation, we see countries like Venezuela and Zimbabwe, where all of a sudden one week you have enough money to buy 10 loaves of bread. Then you take that same amount of money and you try to buy a loaf of bread the next week and you barely have enough money for one loaf of bread. And the next week you go to the grocery store with the same amount of money and you can't even afford a single loaf of bread. That is an example of the complete loss of trust in a currency and the complete hyperinflation absolutely destroying an economy. This is the same thing that happened in the Weimar Republic in post-World War I Germany, when we famously hear about those wheelbarrows of money getting scooted around because the money is so worthless. But when we look at these three countries here, we can draw a similarity between all three of them. All three of those countries' government systems failed to maintain the trust of the people. And that led to the loss of value of the currency, which meant hyperinflation, not money printing. In fact, take a look at the European Union. Take a look at Japan. Both of them, highly trusted, maybe not perfectly trusted. I mean, no government is perfectly trusted, certainly not our own. But I think we could all argue that Japan and the European Union are more trusted than Venezuela and Zimbabwe. And what do you have in those regions? No inflation. In fact, they're trying to create inflation, but they can't even figure out how to create inflation. Look at China. The government has the right to boss around the central bank. We can't even do that in the United States. Our central bank is technically separate from our fiscal government, Congress and the presidency. They're separate institutions. In China, the central bank is controlled by the Chinese Communist Party. But because the Chinese government is cautious and they don't print money willy-nilly, inflation is kept in check. So what about the United States? Well, initially you probably think our government sucks. I mean, we can't get anything done. Like, just look at Congress. It's a complete SHI show. Well, guess what the irony of a gridlocked Congress is? A lower likelihood of spending in Congress, thanks to gridlock, actually tends to lead to a lower likelihood of inflation. And it's not actually directly because they're going to be spending less. In fact, some economists argue that instead it's because a dysfunctional Congress sends this signal of potentially better money management, aka less overall spending, and that signal leads to more trust in our government. So in a weird, twisted way, a dysfunctional government and more bickering amongst the leaders in Japan or the European Union countries, Germany wanting this and Spain wanting that and Greece wanting that, tends to keep inflation down. But when you have massive corruption, which I know many of us might think, well, I think our government's corrupt. Okay, we'll hold that thought for just a moment. When you look at countries like Zimbabwe and Venezuela, where there is blatant corruption, it's no surprise that you have instant hyperinflation. And so what you want to look at if you're thinking about, okay, is inflation going to kill the value of our currency? We actually have to start by looking at demand. Are we going into a frugal decade? And second, how stable are our political institutions? How much trust do we have in our political institutions compared to other countries? Because obviously none of us highly trust the government. All of us think the government sucks. I'm right there with you, okay? The government's messed up. It sucks. It's broken, and it needs to change. But when we put ourselves on a spectrum and we go, okay, European Union, Japan over here, let's put Zimbabwe and Venezuela over here, where does the United States fall? It's still on the shitty scale. Gotta bleep that out. But it's probably closer to the EU and Japan, aka lower inflation. Now, we might see inflation hit 2 to 3% by 2023. That's what current estimates show. But we're unlikely to see inflation in excess of 5% anytime soon. Unless, of course, our country fully corrupts, which is entirely possible. Who knows? These are things to keep an eye on. They're not steadfast rules that can't change. It's just generally, in order to see hyperinflation, you have to see a breakdown of trust and blatant corruption. That's different from just being corrupt. Right? Anyway. Now, let's talk about the second issue. The second issue has to do with the election. Research generally indicates that the S&P 500 will be lower 6 weeks prior to a Democrat being elected, or it will be higher 6 weeks prior to a Republican getting elected. We are currently 11 weeks away from the election today. In a video yesterday, I completely broke down Kamala Harris and Joe Biden's tax plans versus Donald Trump's. Here's a quick little synopsis, and I'll link the full video down below. A Democratic win will signal the following to investors: possible reductions in real estate write-offs, a potential financial transactions tax on stocks of about 0.1 to 0.2%. 3, a potential end of the stepped-up tax basis, very bad for generational wealth. Number 4, a likely increase in the corporate tax rate from 21% to 35%. Number 5, a potential increase in capital gains taxes. All 5 of these things will not be good for the stock market, which potentially will lead to not such good things in the real estate market. In stocks, we'll instantly see every company's price-to-earnings ratio increase if we see the corporate tax gains change. This means stocks will appear to be more expensive than they even are now. That is, if a new tax passes, or these 5 things actually pass. Keep in mind, it's not just going to be about the presidential election. For either leader, whether it's going to be a Republican or a Democrat, to implement their new policies will likely have to take control of the House and the Senate. This is known as a sweep, when one party takes control of the White House, the House, and the Senate. This allows them 2 years of almost unchecked power to change tax policies, or whatever they want. The election of Biden and Harris would probably be phase 1 for higher fees and taxes for investors. Now, this doesn't mean you shouldn't vote for Biden or Harris. I'm staying out of that. But Many believe that a Biden-Harris election could shock the stock market and subsequently the real estate market. However, others believe that a Biden and Harris election might be shocked by these higher taxes, but that impact might get offset because Biden and Harris might institute more rental assistance, more unemployment pay, and more stimulus, which could just prop the market back up to compensate any damage done by higher tax policies. On the flip side, a Trump election might lower the capital gains taxes and lower the corporate tax rate, helping stocks and real estate values further due to low taxation. However, we might see less stimulus. And it also depends who's going to sweep, Republicans or Democrats. That's to be determined. Keep an eye on it. Issue number 3, the pandemic. It's entirely possible that a vaccine does not come to the rescue as soon as or effectively as needed. If a vaccine does not bail us out of this pandemic, it's possible we will see a lagging recovery in retail, restaurants, and travel, which will dampen GDP dramatically and dampen inflation dramatically for the years to come. At the same time, tech companies are likely to surge right through this, creating this sort of K-shaped recovery, where you see sort of the laggers, the retail, the hospitality, the restaurants, K down towards bankruptcy, where at the same time you see tech companies K up towards record highs. Now, some say the state of the election could determine how well the pandemic is controlled. Obviously, this is heavily debated. But here's the big conclusion. Number 1 big conclusion and big takeaway. I personally don't know, and I am not putting my money on fears over hyperinflation. Because even though I agree that our government sucks and it's messed up and it's dysfunctional, it actually could potentially lead to less inflation in the long run. Remember what economists think. It's not a matter of what policies are passed or how much money printing happens. It matters what the public's trust is in our government versus other governments. It's kind of like picking the best of the worst, or at least the top good ones of the bunch of bad. All right? That's conclusion number 1. So for me, I'm not a big fan of investing in gold, and maybe one day I'll warm up to cryptos, but I'm not there yet. Even if I were to be worried about inflation, I'd still do the same thing that I'm doing now, which is regularly on red days buying all of the stocks in my 1337 V4 portfolio. That's the LEAT version 4 portfolio. And you can see that in the link below. Just go to metkevin.com/1337V4. Anytime the market is red, I buy those consistently. If I need to park cash, I go to MetKevin, not MeetKevin, metkevin.com/basket. And if there's a big sale on some of my top heavy stocks like Tesla, Amazon, Apple, Etsy, Peloton, Redfin, I'll buy those. And you can see those at metkevin.com/top. Take a look at those and see what you think about those, but that's my regular move. Conclusion number 2 regarding real estate, if there is a Biden-Harris election and a Democratic Party sweep, real estate could get spanked thanks to the closing of many real estate loopholes that make real estate one of the most beautiful investments to possibly exist, including stepped up tax bases, the 1031 exchange, which doesn't exist in stocks. There's so many loopholes in real estate that just don't exist anywhere else. Either way, I'm personally still going heavy on real estate as well. I'm dramatically increasing my real estate portfolio, buying deals below market value, like I teach in my real estate investing course, and we talk about daily on our investing live streams. The beautiful thing about stocks and real estate is even if hyperinflation does come, in the long run, stocks and real estate tend to be able to survive through inflation, and they have their gains on top of whatever inflation is. Then, number 3 conclusion, no matter what happens with this pandemic, it's really important to know that right now, as we're in the pandemic, be careful about going heavy on retail, hospitality, and other what appear to be value stocks that'll do really well when a vaccine comes out. And you know what? I've got exposure to them as well, but I'm keeping my exposure under 10%. Because even though they might skyrocket and double and triple and quadruple when a vaccine comes out, these companies are going to be saturated with debt, and I'm not putting a lot of my eggs in those baskets. Most of it is going into my top stocks and my indexes. There you have a complete breakdown of all of my thoughts on this crazy market that we're in right now and the big dangers that we're facing. Please consider getting your life insurance in as little as 5 minutes via the link down below. Get 2 free stocks with Webull when you deposit just $100. And of course, check out the amazing courses on how to make YouTube videos like this and edit them in under 5 minutes. And heck, you know what? check out the real estate investing course and the course on money and stocks. Thank you so much for watching, folks. We will see you next time.